Hi class, welcome to chapter 14, put and call options. This is a pretty complicated chapter. At least I've always found this stuff a little more tricky than others. So just keep that in mind. I'm not going to require a mastery of this topic for this week. I just think for this level in this course, it'd be a good introduction for you. Okay. So some of the objectives of this chapter is understand the basic concept of an option. Okay. Distinguish between the put and call option. Define strike price, intrinsic value, and speculative premium. Describe speculative and hedging strategies with options. Explain how option contracts are closed out at expiration. Be aware of the tax and commission factors associated with options. Okay. Put and call options. So option markets, the options clearinghouse, basic option strategies, and using options in combinations and other option considerations. Okay. So what is an option? Okay. The book and the slides give the perfect answer. It's the right acquired for a consideration to buy or sell something at a fixed price within a specified period of time. Better way to say that, and the book uses this as an example, would be to compare it to putting a down payment on a house. So let's say you want to buy a house. What's the first thing you do? Well, you have money you're going to put down. And what is the money, you're putting this money down in anticipation of getting the loan. If you put this money down and you can't get the loan, you might be out, that $2,000 down payment you put down. Probably more. But all right, so for this example, let's say this. Okay, you see a house, $100,000. You want to buy it. You will put down $2,000 and you'll sign a contract with the owner, right, of the house. And basically your $2,000 down payment just bought you an option to buy the house for the next 60 days. It's usually a fair amount of time, right? So you just bought a 2-month option to buy the house. Now you could back out and not buy the house. And what happens? You lose the $2,000, right? Or you could move forward with it. So you paid a small amount down to have the option to buy this house, right? That's how options work. Okay? A put allows the option buyer, the owner of the property, the right to sell 100 shares of common stock at a specified price for a given period of time to the option seller, also known as the writer. Okay. Now this is how it works for calls. I always have a hard time with this, guys, so just read it a couple times and make sure it sinks in. A call allows the option buyer, okay, the owner, the right to buy 100 shares of common stock at a specified price for a given period from the option seller. Okay, pretty straightforward, but you have to get them confused because you could be writing the options or selling the options. Okay, so option contracts are listed. Contracts on the unlisted puts and calls have been standardized and can be bought on several different exchanges. Option Clearing Corporation is equally owned by major trading exchanges. Over 3,600 individual equity options trade on option exchanges, options on stock indexes as well. So you can buy options, is what the slide is telling you, on a ton of stuff. Stocks, indexes, ETFs, etc. Okay? So I wouldn't focus too much on this, but standardized expiration dates. You have a right to buy the house. It's for 2 months. That's a standard contract. Basically, what this is trying to say here. Okay. Here's a list of option exchanges. I will never ask you to memorize this kind of stuff, but just good to know. I was in Chicago this past weekend for work and got a quick glimpse of the options exchange in Chicago. Pretty neat building. Okay. Option premiums, the amount per share the option buyer pays to the seller. The premium is primarily affected by the difference between stock price and strike price, time remaining for option to be exercised, volatility of underlying stock, interest rates, market conditions, and dividend rate of the underlying stock, if there is a dividend. Okay. So, in the money call options, okay, is when the intrinsic value equals the market price minus the strike price. Okay? So they just give you an example below. You have in January a call option that's $17.50. Okay? If the market price is $18.93, we take away that $7.15 $17.50 to get the $1.43. Okay, options that are out of the money will have a negative intrinsic value. It's a very important concept here, guys. This is all really easy math. It's just understanding the basic concept. Okay, options that are out the money have a strike price and stock price that are equal. Intrinsic value equals strike price minus market price as well. Just switching around the formula. Components of total premium on a call option. So intrinsic value plus speculative premium. Okay, and it further breaks down the equation there. Okay, speculative premium, a little more on it. The higher the volatility of the common stock and the lower the dividend yield, the greater the speculative premium. Okay, the longer the exercise period, the higher the speculative premium. All right, so if you had, think of it like that. Why does time matter? Well, time matters because you're locking in this option, for a longer period of time. You're getting a better deal. Like if you have the right to buy that house for 4 months instead of 2 months, isn't that worth more? Would you put an extra $1,000 down? Maybe. The option's worth more money. You have more flexibility. Okay, and that's actually the underlying reason, why people trade options is to get flexibility. Here we go, speculative premium and the time factor. So it just gives here just a little bit of breakdown. I won't go over this. Okay, speculative premiums, betas, and dividend yields. High beta stocks have higher speculative premiums, right? Why? Well, as we know from our previous chapters, higher beta stocks are more volatile, right? There's more movement to market changes. Stocks with low dividend yields more likely to have higher speculative premiums. High beta stocks, high speculative premium, low dividend yield, high speculative premium, high dividend yield, low speculative premium. Okay. Other option premium and other factors, market conditions, the individual company, future expectations, interest rates. Call writers should write short-lived calls on a continuous basis to get maximum return. Just some more basic information here, guys. Basic option strategies. The leverage strategy is useful when the market is expected to rise. Right? Think about that. If you know what leverage means, then it makes perfect sense. So you're using less money to buy more. So for example, going back to housing, you could essentially at one point buy a house, the $100,000 house with no money down, right? Now you probably need to put $10,000 down on at a minimum for most people on a $100,000 property. Okay? So what happened? When you're buying the house with no money down, you're higher leveraged. Okay? Leverage strategy, November 15, call option is increased by 13.1 times. The percentage move is moving the common stock. Okay, so it's just showing how leverage increased on the stock, right? Single systems call, this excludes commissions, assumes the option is held until the day of expiration. No speculative premium exists at expiration. This is also how the book won't go into this too much, but European call options and puts work as well. They go to expiration. Ones in the U.S. Can be exercised at any time. Buying call options can be used to get maximum leverage, right? You're going to, pay a premium to buy that stock at a certain price. So, you want to make sure, you can buy it low to sell it high, right? That would be the option, okay? Buy call options instead of stock. It's a risk. You're risking smaller amounts of money. Can reduce losses when stock prices are falling by a significant amount. Right, you can use it to stop your losses. Okay, protecting a short position. Okay, reduces risk of rising stock prices. Reduces profit of short position by total premium paid for call. Guaranteed price allows investor to purchase the stock at the exercise price after the price of the stock has increased. If the price of the stock declines, buy the stock at the lower price and consider the option policy, premium just an insurance policy, right? Okay. Writing call options. Writers of options take opposite side of the market from buyers. The writer is expected to short, is similar to a short seller, okay? Except expect stocks to decline or stay the same. Writers profit when prices decline or stay the same. Writer of call options receives speculative premium. Writing covered options. The writer owns the underlying common stock and then writes a call, writing covered options on it. Okay, to what? To protect their position, right? If the stock price declines, the writer's loss in the stock is partially offset by the option premium. Okay, a naked option, the writer does not own the underlying stock. Right? That's the difference. Okay. Buy and put options. The owner or buyer of a put may sell 100 shares of stock to the put writer at a strike price. Okay, put strategy is similar to selling short or writing a call, except loss limited in total investment. Okay, your loss is limited to what? Just the premium. No risk exposure if stock rises. Buy put in anticipation of a price decline. Using options and combinations. Buying one option and writing one option on the same underlying stock. Straddle. Buying a put and a call on the same stock with the same strike and expiration. It's used to take advantage of volatility is what that's saying. Okay, and as we see there, we see a big hint with volatility, right? Usually applied to high beta stocks. Okay, it's it's speculative, right? Tax laws related to options are constantly changing. How can they be taxed? We have the election coming up in a few months as of the recording of this video, and I can tell you there's a concern in my industry about taxes going up. I'm not saying it's a good or bad thing. I'm just saying that they're going up, and that affects the way people make decisions, right? If you had profits, high profits on the stock, if you anticipated taxes to go up January 1st, you might say, I'm selling my stock. I'm going to take take the tax gain this year. We're at a lower rate. Okay. And that's it for this chapter, guys. Please email me if you have any questions.